any rate, I think we'll get started. Welcome to all of you. It's great to have you with us. We have a good crew today, and appreciate your questions. Merry Christmas and all of that good stuff. If you're freezing, keep warm. If you're down in the warm parts, well, we'll be jealous of you. How does that sound? We've got a fair number of questions. As I started to explain, maybe some of you heard that we're on a minute ago. We have an HRA question that was asked by Craig, and it's extremely complex. We're going to talk about benefit plans in general for a minute, and I want to talk about scams specifically because he raises a couple of issues there. Rob Thurston is going to join us in a little while. Rob is the co-author of the benefit plan retirement savings plan set that most of you have, and he's one of the national experts in benefit plans. So we'll have him with us here in a few minutes and discuss some stuff, but most of Craig's questions are just so complex they're going to have to be answered individually. Question is, best state for an LLC. We've done this before, and if you've heard and know the answer, then bear with us for 2 seconds. The best state for an LLC is the state where you reside or where you are doing business, actually. The business has to be located, has to be registered in the state where it's doing business. So if you have an LLC that owns a home in Indiana, we'll pick on Indiana here for 2 seconds, see if we can warm you up. But if you have a house, a rental in Indiana, and it is owned by Florida or a Nevada or a New Mexico or a Wyoming or whatever LLC, that LLC still has to be registered in Indiana. It is subject to all of Indiana's laws. It pays all of Indiana's fees. There is no more privacy because all of Indiana applies to it. So am I missing something? Why would I ever do my LLC or my corporation in Nevada if in fact my property or my business was in Indiana? Because I pay all of the Nevada fees, I pay the registered agent dude in Nevada. That's why he talked you into registering in Nevada, by the way, so he could get his registration fee or his registered agent fee. You pay the state registration fees in Nevada, and you have to pay everything in Indiana, and you're subject to all the laws in Indiana. If I'm your renter, I'm going to sue you in Indiana. I could care less that you have a company that's registered in Nevada. And by the way, if you don't register in Indiana, guess what? I'm not paying rent. And there's nothing you can do about it because you are not a citizen of Indiana. You can't evict me. You can't sue me. You can't do anything to me. So you've got to have your LLC in the state where you are doing business or where the property is, and ideally where you live, because then you can be the registered agent. You don't have to pay some idiot to do nothing, which is what a registered agent does nothing except receives one piece of mail from the state and forwards it to you every year so that you get to pay your state fees. Oh, and they bill you too. And then if you're ever sued in Wyoming or Nevada or Delaware or wherever it is, they will immediately sign, they'll sign for the lawsuit, they'll accept the lawsuit on your behalf, immediately send it to you so that you have to do everything with it. This whole concept of where is the best LLC, Nevada, New Mexico. New Mexico seems to be a big one these days. New Mexico, oh, there's a big group in Utah that's running around saying you should do it in Utah. Actually, Utah has the worst LLC laws in the United States. Why would you do it in Utah? And I'm in Utah. Trust me, I know. But they are charging people $5,000, $6,000, $10,000 to set up these LLCs, and they do seminars, and then they charge them their $500 a year, or whatever it is, for the registration fee, and they're just soaking these poor people. And my answer is, if you've got one in Utah or Nevada, just get rid of it. Just have your LLC in the state where you are doing business or where the property is. That's where you have to have it. If you happen to be living in that state, you can be the registered agent. You do not need a registered agent because the registered agent doesn't do anything. And I heard some chip, chip, chips. Is that okay, Soraya?
Lee, I'm on the call. This is Rob Thurston.
Rob Thurston is chip, chip, chipping, huh?
Yes.
Rob just came in. It was Rob coming in. Rob, welcome. How are you?
Fine, sir. Thank you.
We were talking about what's the best state for an LLC to be in. And we actually, 2 seconds ago, said that you would be on with us. And I'm going to have you talk about HRAs with me for 2 seconds. Craig has sent us a huge list of questions, and we're just not going to go through it because they're not relevant to most of the folks on the call. But maybe I can con you into answering them for him privately at some time. An HRA is a type of benefit plan, and Rob is one of the, as I explained earlier, the national experts in benefit plans. He's been doing this for 30 years?
35.
35. I remember Rob and I got together back in 1983,
Yeah.
and something like that, which is a while back. And Rob designed one of the first 125 plans, the flexible benefit plans. Was that Dade County down in Florida?
That was, but I'm more proud of IBM that I did in 1981.
81, back, that was one of the first ones. Anyway, Rob's been doing this forever, and he's still doing it, and he might get good at it. So, I mean, he's good at it, but there are 2 types of what we call ERISA plans, Employee Retirement Income Security Acts plans. One is the retirement stuff, and you're familiar with the 401ks and the 403s and all of that sort of garbage, and the SEPs and the SAPs and all of that stuff. The other aspect of ERISA is the benefit plans, and your advisors down the street don't understand benefit plans. They understand retirement plans because they make a commission off of all of the junk that they sell you in your retirement. But benefit plans are a different animal, and they are a neat tax tool, as is the retirement planning stuff. But the benefit plans are kind of a forgotten area, and yet they're an extremely powerful area. The HRA, Health Reimbursement Agreement, is one of the neatest plans that you can have because basically you can buy benefits with it. That would be mostly the health stuff. You can pay premiums, you can pay the doctor deductibles and the prescriptions, and we even used to do the over-the-counters before Obamacare, right, Rob?
Yes.
And, you know, we used to take off the aspirins and the toilet paper and everything else. And yes, toilet paper is very healthy. You try not using it for a while, guys. I could go on. The real problem is that Congress did away with that, and they just don't understand the paperwork. Never mind. But at any rate, Rob, 2 things. The HRA, if I have a small business, I'm doing real estate flips and stuff, is it practical for me to have an HRA? And in the HRA, I can,
yeah.
In the HRA, I can contribute money from my business to the HRA. It's easy. It doesn't have a lot of reporting with it. I contribute the money that is tax deductible to my business. It goes into the HRA account, and then that money can be used to pay for the medical type stuffs. The nice part about it is the expense to the business is above the line, which means it lowers my adjusted gross income, maybe gets me out of the alternative minimum tax. We have a question on that in a little while. But it's a good tax tool, and it basically allows you to make all of your medical stuff not tax deductible, but pre-tax, and that's a huge difference. You can't really deduct your medical unless you meet over 10% of your adjusted gross income and all this and that and the other. But if I can pay for it through the HSA or the HRA or one of these plans, it becomes pre-tax to me. And so it saves me a ton of money. So back to my question, Rob, and I'm sorry to have made the diversion there. Is it practical for me as a little guy to have one of these animals?
If you have one employee or less, in other words, you're the employee or your spouse is the employee, the answer is
well, in my business, I have one employee, and it's probably less because I don't do a lot. But so yes, one business guy, one person.
Okay, then the way to go would be an HRA. It definitely would under Section 105, and it's employer funded, so you get to fund the amount. And no, there isn't a limit on the amount you can carry forward. So if you don't spend all the medical expense, all the money in the account.
So it's not one of these flexible benefit plans that we don't have a use it or lose it rule.
No, you don't on that. I mean, you can put a cap on how much you're allowed to carry forward. And some of our competitors, like Zane Benefits, have a cap of 4 times your annual contribution. But no, they're under the law, you can carry forward all your money from year to year pre-tax. And as long as you use it for medical expenses, it's an asset that, you know, you carry it forward even into retirement and can use for qualified medical expenses, Lee.
So it's called a reimbursement plan. So I go out, I incur the cost, and then to the plan, which is me, I submit the bill, the receipts, and what I do is I keep all my receipts in an envelope, and then we don't do it very often, semi-annual or annually. We add up all of the receipts, and then we reimburse, just cut a check out of our checking account, which is called the HRA account, and then that money comes to me. It's a reimbursement. There's no 1099 on it. There's no nothing. It just basically goes under the board. But the business has funded the HRA and gotten a tax deduction for it. So
yep. Pre-tax. Pre-tax. Yep.
Yeah, pre-tax. So I've now made all my medical expenses pre-tax. What are the requirements for, do I have to file a tax return for this? Do I have to, you know, what are the reporting requirements? All the discrimination requirements and all that crap.
Well, there is no discrimination per se on this as long as all employees that are employees working over 30 hours or more a week are covered. And small business, like the one we're talking about, only one employee, there's no issue. If you do issue a W-2 to yourself, you would report on line 13 what is called health expenses. And there's a form 1094 that you have to file. But the good news is Trump has already said he's going to be doing away and delaying the filing of this 1094 form. So for all of you business owners out there, you just would keep track of the total amount that you spent on it, keep your receipts, and you take that deduction as a qualifying health expense. Now, if you have 2 or more employees, if you have 2 employees or less, then you have to have an insured product. And Transamerica happens to have qualified an insured product that will reimburse for health reimbursement expenses. It's kind of complicated. You pay them a premium, etc. If you've got 3 or more employees, it has to be part of a high deductible health plan subject to all the Obamacare stuff. And I would not suggest you use an HRA at that point. If you've got 3 or more employees, you want to go to the health savings account.
The advantage of the HRA is it's a little easier in that we do not need a qualified trustee to manage the money. I can manage my own HRA money, whereas with an HSA, you do have to have a qualified trustee, and right. That's why equity trusts and all of these guys are pushing HSAs, not HRAs, because they don't get anything out of an HRA. So
yeah,
these
exactly
are
right.
neat plans. What about the scams? You mentioned Zane benefits, and Greg is heavy into researching Zane benefits and stuff. I know that a lot of the plans, how's Zane making its money? How do these guys make money off these?
Well, they charge an administration fee. They tell you that you have to have them administer the plan. So they'll charge you for the legal document. And Lee, you know, our LegaLees books are a steal because, you know, we keep them updated. So if Trump changes the law, we're going to update those documents.
Oh, thank you.
Zane and them, they charge a huge fee for doing the document. They charge a separate fee for the summary plan description. They charge a separate fee for filing instructions. They charge a separate fee for the implementation checklist. And then they charge an administration fee. So every time you use either the debit card they provide you or they process one of these paper claims, they're charging you a fee. What we've done with our LegaLees,
do all of this myself, right?
Yeah, absolutely. And that's the beauty of what we've given you. It's all there so that you can self-administer.
Rob actually helped me update your HRA documents last summer. So they're only 6 months old. We're going to have to do them again when I got a cramp in my leg.
Yeah, if Trump, and by the way, I'll make some predictions here. So Trump's going to do a lot of the paperwork and the filings and all of the things that restricted flexible spending accounts and health savings accounts. I think Trump will do away with it. I think in the next 6 months you'll see super HSAs. So might not even have to be in a trust. There won't be the caps or the limits that are set. And HSAs are great too because the money goes in pre-tax. It accumulates and can earn interest, and that can be pre-tax, and you don't have to pay tax on the interest. And when you withdraw it, as long as you withdraw it for qualified health expenses, it's pre-tax. So
now,
go ahead.
Yeah, go ahead, finish.
So HRAs are great for 2 or less, or especially if you only have 1 employee. HSAs are probably the way to go. And I think Trump will also uncouple them that you have to have a high deductible health plan. I think he'll just say, hey, if you are a business owner or you're an individual and you want to fund $5,000 or $10,000 into an HSA, I think that's going to be happening in the next 6 months.
Okay. Question. Yeah, we just had another question. Sarai's going to read it.
Yeah, we have a question from Don, basically asking. Let me pull up the actual thing. Under the HRA, do health insurance premiums become pre-tax, or is it just the medical expenses that become pre-tax?
You can't run your premiums pre-tax through a health reimbursement arrangement. For that, as long as you're a W-2 employee, you can run those through Section 125, which is called the Premium Only Plan. And again, Lee and I have given you a summary plan description of a legal document and the filing instructions. And you don't even have to file a legal document with the IRS or the Treasury. You do a Premium Only Plan to do pre-tax your premiums.
Cool. Do you want to go on a little bit more about the difference between an HRA and an HSA as well?
Sure. Flexible spending accounts, those were the things that I was really excited about back in the early 1980s. However, they had use it or lose it. If you didn't spend the money at the end of the year, the money would go back to the employer, even though it was your money that you put in through salary reduction. Well, for 2017, and this is brand new information that all of you out there want to write down, the maximum amount that you can salary reduce is $2,800. $2,600, excuse me. Went up by a whopping $50. So it's $2,600. The employer can contribute as much as he wants into a flexible spending account, but again, at the end of the year, there's use it or lose it, except you can now roll over or carry over up to $500, or if you set up the legal document, and our document gives you the way to do it either way, you can have a 2.5-month grace period. So after the end of the year, you have 2.5 months to incur additional expenses and get them in and get reimbursed, so you use up all the money in your account. So that's what an FSA is. Don't get rid of FSAs because it reduces the amount of FICA, that's Social Security, that you have to pay, or federal unemployment tax that you have to pay. And so it saves you as an employer money by having an FSA. And there's no reason you can't have an FSA as well as others, but the FSA can be restricted to certain expenses like child care or for, prescription drug costs or things like that. I wouldn't be surprised if Trump again starts allowing over-the-counter or vitamins and not the toilet paper. That Lee was being funny on that. But, vitamins.
Very healthy. You try not using it, Rob. At any rate, what I was going to say was Equity Trust and these guys are all pushing the HSA as a real estate investment vehicle.
Mm-hmm.
They're saying, oh, put your money in the HSA. Now you could put it in the HRA too, and if you don't use it for medical, then you can invest that fund. And if it's an HSA, you have to have Equity Trust work with you. If it's an HRA, you can invest it directly. I'm a little worried about investing in real estate. I certainly wouldn't invest directly in real estate. I would set up a company, an LLC or a corporation, and then have your HSA or HRA fund that entity, and that entity can then buy the real estate. But maximize out your retirement plans first without trying to play the game with the benefit plan first.
I would agree.
Can I move funds from an existing HSA to an HRA? And the answer would be
no.
I'm going to guess. I'm going to say no.
It's no.
No. These aren't like retirement plans.
Not unless the employer terminated officially that plan. And then there's rollover provisions, but usually you would roll it over into a like account, not into another code section, another qualified account.
Yeah. So at any rate, Rob, we'll have you talk to Craig personally on this and answer his more detailed stuff. But hey, thank you for joining us. Rob runs a benefit planning company, and he can help set up plans and do things for you. And it's often easier to have a professional do it than try and do it yourself. Although the materials that we've prepared for you do allow you to do that, and we have a lot of people who do it themselves. And then Rob has a lot of clients himself. If it's a bigger company or something, I'd certainly have Rob work with you on that. Anyway, thank you, sir. I'm going to hurry and answer the rest of the questions, but appreciate you tuning in and being with us for 2 seconds on the HRA stuff. Let's go on. We did that one. I've got a family with 5 peoples in it, and they're making about $100,000 a year. The question is, how do you reduce your adjusted gross income? The easiest way in this case would be to contribute to an HRA or some such thing, but real estate is probably your best bet. And the depreciation on the real estate is going to go against $100,000, and it will allow you to take up to, I think it's $25,000 in depreciation loss on the real estate. People, and it took me, frankly, a long time to figure this out. People who had real estate I knew were getting wealthy, and they made money. Well, you make money because the real estate appreciates, and the concept of having the renters pay your mortgage is a wonderful thing. But there's a hidden thing to real estate, and the hidden thing to real estate is the tax. And there are people who I know who have hundreds of rental units and stuff, and they don't pay a dime in tax. And during the election, there were, you were talking about Donald Trump. Yeah, he lost a ton of money. He went into Atlantic City and lost his shirt. But the tax implications of that have carried him for years. And, he doesn't pay tax. And it's the real estate stuff, perfectly legitimate. But it's a huge advantage. So benefit plans, retirement savings plans, even your your IRA comes out above your AGI calculation, the standard IRA. So these are types of things that you could do. The advanced tax tactics, it's online, is 10 ways that somebody can reduce their AGI. And years ago I went out on the internet and looked for ways to reduce AGI, and I didn't find much. In all seriousness, straight-faced, one of the major websites says the way you reduce AGI, adjusted gross income, is you adopt kids. These people have obviously never raised a child. You do not raise kids for tax deductions. But there are easier ways to get a tax deduction. I have somebody who apparently has an in-law, son-in-law, or daughter-in-law who they don't trust with money. And so when they die, the question is, how do I set it up so that my son or my daughter gets the money, but my in-law, my son-in-law or daughter-in-law, don't get any of the money? And the answer is, if you give it to your daughter, your son-in-law is probably going to have access to it. If we put it in a trust and have somebody else manage it on behalf of your daughter, then they can meter it out to your daughter and give it to her one piece at a time, so to speak, and she can spend the money, and that would be a way of protecting it from the son-in-law or the daughter-in-law that you didn't want to have access to the money or your estate. So you're going to keep it in trust. You're going to have somebody else act as the trustee, not your son or daughter, and then they're going to meter that out to the child, your son or your daughter, over the years, and they can give it to them in specific chunks in order to accomplish what your son or your daughter want to accomplish. Now, it could be a really sore point with your son-in-law, and he could put a lot of pressure on your daughter to get that money and to spend it, but in theory, the trustee can withhold and manage the money on behalf of your child, and the son or daughter-in-law doesn't get access to it. Bigger question is, I'm divorced, and I have my kids, and I want to make it so that if I die, my ex doesn't get anything. Because if I give the money, my estate, to my kids, my ex is going to get custody of the kids. The ex will always get custody of the kids, even if you have custody of them now, and the ex will then have access to all of the money that the kids have. Well, the situation is you put it in the trust and you have somebody other than your ex be the trustee, and that trustee can meter it out to the kids. They can specifically buy them the violin, or they can send them to Europe on the school trip, or they can do this or that and the other, and the ex doesn't spend the money. They use it directly for the kids. That's trust for a grandchild. And I didn't quite understand the question because I don't know the purpose. If we're going to shift income to the child, the old way of doing it was to set up what we call a children's trust. And it's an irrevocable trust. Daddy or grandma puts money into the trust. The income that money or that property that's in the trust generates then goes to the children or grandchildren. And in the old days, the rich people used to move a lot of money this way. They would shift the income totally. You know, we put $1 billion worth of IBM stock in it. IBM, well, let's see, Verizon stock. Verizon's paying a 4% dividend right now, and we put $1 billion worth of Verizon stock in there, And so all of those dividends don't come to me anymore, they go to the child. About 40 years ago, IRS decided they didn't like that deal, so they implemented what was called the kiddie tax. And if a child, it started out to be a younger child, got the income, then basically the child had to pay the income tax at daddy's rate. In fact, the income that's generated is actually stacked on top of daddy's income, which raises daddy to a higher tax bracket. And then the tax is calculated and the child has to pay the tax. This is only passive income that we're talking about, but that's what Verizon is doing, is they're paying the 4% dividend. That's passive income. We put a rental property in it, pays rent, that's passive income. You can't shift earned income. So we used to have the Children's Trust, and it did that. Today I wouldn't use the Children's Trust. I would use an LLC in order to put the property in, have the child own part of the LLC, and then the child would get the income that the LLC's property generated. We're still subject to the kiddie tax. Obama raised the kiddie tax ante quite a bit by making it so that even 26-year-old kids are considered kiddies if they're at home and not full-time students and not married and so on and so forth. Shifting income certainly works good for mom and dad. If we're trying to help them in their older years, why should you pay the increased tax? Have it go to them. If the question is, how do I use a trust for a grandchild and I'm going to leave property to them and they're going to inherit it, that becomes a different question. For example, if I have a farm and I want the kids or the grandkids to have the farm, I probably don't want to break up the farm into 6 pieces, so I'm going to put it into an LLC and then give the 6 kids their interest in the LLC. That could be the same type of situation with a piece of property and the grandchildren. If there's stocks and that sort of stuff, I could leave it in living revocable trust. When you die, the living revocable trust becomes an irrevocable trust, and you can have a trustee, and that trustee can manage the property on behalf of the grandchild. So not quite sure what the question was. I probably wouldn't use a trust today unless, well, let me back up. If I'm setting up I've got a chunk of money and I'm going to set up a trust, yes, that would be the revocable living trust that converts to the irrevocable trust. So I'll write into my living revocable trust that when I die, $500,000 is going to be set aside in this irrevocable trust, and it's going to be used for the education of my grandchildren and great-grandchildren, or I can dictate what it's used for. The trustee then is required to maintain that, to invest the $500,000, get a return on it, or they need to be conservative because they're personally liable if they lose the money, but they will then have that go out and they can use those funds for the education of your posterity, your kids, grandkids, great-grandkids, whatever it is. So it depends upon how you're looking at it. We have a case where the parents had a trust, mom and dad are dead, the daughter is the trustee, or the child is the trustee, and the question is, how do I transfer the home, which is in the trust, to me? I'm the only heir. I'm the trustee. Do I leave it in the trust? What happens? Well, when mom and dad die, the trustee, the daughter, is going to marshal all the properties in the trust, the bank accounts, the house, and that sort of stuff. And depending upon what the trust says, in this case, it was implied that the child was the trustee and the only heir. The trustee will simply make out a deed, sign it as trustee, make out the deed to themselves their name as individual, and it will be transferred out of the trust, and it will then be yours. It'll be yours. You'll have title to it. It's basically the same with the bank account. When mom and dad both die, when the last one dies, the trust becomes irrevocable, which means it has to get a tax ID number, and it basically becomes a little business. The trustee will manage the little business and follow the terms of the trust, which says to pay it all out to the kids. As the house is sold, or as the stock sold, or as it's divided up, they'll divide it up and issue each kid their share of the stock in that child's name. It's now outside of the trust. The trust gets a deduction, basically, on the taxes for paying out the income or paying out the principal. So when we get rid of all of the assets, the trust dies, effectively. It has nothing in it. It files a final tax return, which says we're dead. You just check the box and say this is the final return, and the trust disappears. The trustee's responsibilities are over. The assets of the trust have been transferred to the individuals who are named as the beneficiary. So I hope that helped on that. We've got an individual who's been doing research on investments and trusts, and they say, well, if I set up an LLC right now, before the end of the year, could I make those research, investment, and trust expenses and stuff tax deductible? The answer is probably no, for several reasons. One, what would the business purpose of the LLC be? In order to get a tax deduction, the company, the LLC, has to make the expense which is reasonable and necessary. Those are the magic words. And I'm sorry Ben's not with us. He's on the road at the moment. Ben is the individual who does all of our tax stuff. He's actually very good. He was a special auditor for the IRS for 7 years, and if you guys are, any of you are paying a huge chunk in taxes, let's say over 30, 40, 50,000 this year, you need to talk to Ben immediately, because there are still things that you can do. I'm not sure that this is the thing that you would do, set up the LLC and try and deduct it. You can deduct the investment research and stuff as investment expenses, and you can do that on without setting up the LLC. Got a W-2 wage earner again. He wants to avoid alternative minimum tax. The alternative minimum tax was put into place 1978, I believe it was, to make sure that the rich paid their fair share. You heard that one before? You know, it was only going to hit the rich. Well, today, and it depends upon how you earn your money, whether it's earned income or passive income or blah, 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 but it's going to kick in, the alternative minimum tax kicks in $70,000, $80,000, $90,000, somewhere in that range. And then literally what happens is an alternative tax calculation is made, which increases your tax. You have to use a different method of calculating your taxes, and that method is going to guarantee that you will pay more tax. You need to lower your adjusted gross income, your AGI, because that 70, 80, 90,000 that I talked about, that is AGI, adjusted gross income. We talked about it earlier. If you make a contribution to the HSA or the HRA out of a little business, yes, start a business. The business allows you to set up the retirement plans or the benefit plans, the 401k. Contributions made to the 401k come out on top of the AGI calculation. It's what we call above the line. And if it comes out above the line, then it is a deduction or a contribution to the AGI calculation. So you're going to start the business. That's a perfectly appropriate thing to do. You can invest in real estate. Real estate would help you drop your AGI, and maybe get you down to where you don't have to pay the alternative minimum tax or do the alternative minimum tax calculations. So those are things that, that you could certainly do. Benefit plans, retirement plans, real estate, those are all good things that you can do. The depreciation on the real estate, good things that you can do to help lower your AGI. We've got an individual who's refinanced properties and switched from their personal ownership to an LLC ownership. And the question is, what's next? I assume that's in an asset protection mode. I've got a couple of questions, though. Was the refinance made in the name of the LLC, or was it made in your name and then the property was transferred into the LLC? If it is, if that was the case, the mortgage is in your name, the property was in your name, and now you've moved it into the LLC, if that's the case, then technically you have now violated the due on sale clause on your mortgage. Now, nobody's ever worried about the due on sale clause. Due on sale clause was implemented in, what was it, 1981. And I bought my first house in 1981. And I got a smoking deal. The lady let me carry her mortgage. It was an assumable mortgage. Actually, she basically sold it on contract to me, and I only paid her 12% interest. And that was good. That was really good. 12% interest? Well, the problem was that mortgage was assumable. The mortgage company couldn't do anything about it. So they got Senator Garn from Utah and Senator St. Germain, and they conjured up the Garn-St. Germain Act, which said that if you transfer ownership of a piece of property, then the mortgage is automatically due and payable. You've violated the due on sale clause. They added due on sale clauses to mortgages. They didn't have them before that. But they hadn't really faced a 15, 18% interest rate hike. Well, the fact of the matter is, since 1981, where have mortgages gone? Straight down. Well, the feds raised the mortgage rate yesterday. Yeah, they didn't raise it much. But if inflation goes wild and we hit a 18% mortgage rate, these mortgage companies are coming back. They're looking for any way they can to get out of their 3% mortgages. So you need to be thinking about that. Next question. Is the insurance still in place? If the property is owned in your name and you insure it, then you transfer it to an LLC, you have canceled your insurance, basically. The theory is that a commercial property is at a higher risk than a residential investment property. So if the place burns down, you might not likely be insured. Yes, you can certainly get insurance on the property that's in the LLC. It's going to be 3 times as much as it is for your individual investment piece of property. Now, I recently went down and changed all my properties to LLCs. The plumber has leaky pipes. It took me years to do this, and I finally did it a couple years ago. And my insurance agent went to bat for me, and basically he got all of the insurance companies except one property to say, okay, we know what's going on. We've moved it into the LLC. We will put the LLC and you as named individuals on the insurance policies. And you get to pay the same private investor insurance rate. So you can dicker with them and you can work with them. What's next? Well, you've got them into LLCs. That's good asset protection. Great thing to do. I'd probably set up a management company to manage them. I wouldn't ever have the renter sign the lease agreement between me and the renter. It's always between the renter and a management company. The management company hires the people who come in and do the plumbing and do the yard work and all the rest of that stuff. That imposes a huge barrier between you and what we call the cause of the lawsuit. There has to be a causal connection. Did I hire the guy? Did I cause the problem? Did I do this? Well, the fact of the matter is, if the manager is in the middle of all of this, and that could be a company that I own, and you got to understand that company is not me. It's different than me. If that company has done all of this, then that company has caused the problem. If they hired a bad plumber and he burnt the place down, that company is the one that the rentor is going to sue because that's who their contract is with. And that company doesn't own much. It's just a management company. It doesn't own the properties. They're owned by the other LLCs. So you've added basically a huge layer of asset protection by having the management company. And the management company does everything related to these properties. I have a management company. It does everything related to the properties. Now you've got to be careful that you don't commingle money and you maintain the companies and all this and that and the other, but it works really well. We're down into some questions that I didn't understand particularly. We've got apparently the individual has bought a home and there's a medical lien against the home with the county. And the question is, do I have any ideas for getting this medical lien or negotiating with the county for this medical lien? Well, what happened to your title insurance, guys? The title insurance should have picked up that medical lien. And my wife, Christy, is one of the few people who's ever actually collected against title insurance. But if you've got title insurance, that should help in this situation. And other than that, I don't really understand the question well enough to answer it, but we should have picked that one up before we bought the piece of property. We have a Canadian question. He wants to buy tax liens and tax deeds and stuff in the U.S. You can buy anything you want in the U.S. That's fine. But if you're going to sell it, you first have to get an individual tax identification number, an ITIN. They're not easy to get, actually. You have to have a qualified guy in the U.S. to help you get it and all this and that and the other. Then you'll sell the tax lien or sell the piece of property, and it will be required that 10% of the gross will be withheld on that sale in order to satisfy the taxes in the U.S. You're going to have to file a tax return under your ITIN, your tax number, your Social Security number basically is what that is. And, you know, it's like a SIN number. But you're going to file your U.S. taxes. Now here comes the $64,000 question. Am I double taxed when I take the money back to Canada? The answer is if all of this has been done as an individual, Canada will give you a deduction for the amount of tax that you paid in the U.S. Or if it's done as a partnership, Canada will give you a tax deduction on your Canadian taxes for the amount that you paid in the U.S. in taxes. If it's done as an LLC or a corporation, no, you don't get a deduction in Canada for the amount that you paid in the U.S. So basically you have a double tax. Anyway, I hope that helped answer that question a little bit. Offshore IRAs versus U.S. IRAs. I don't quite understand. I don't understand offshore IRAs. An IRA is a U.S., United States government law which allows you to put money into an account, and you have Roths and standards, obviously, but they need to be in the United States. yeah, you could probably make investments in offshore companies and stuff, but you have the tax advantages in the U.S. already. They are protected by law in the U.S. Asset protection-wise. I don't know why you have to go offshore for an IRA. It just doesn't make any sense to me. Now, there may be something I'm missing, and there are lots of things I miss all the time. I can certainly be educated, and if I've missed something big here, please give me a call and let me know. But your U.S. IRAs are in the U.S. You need a U.S.-approved trustee for your IRA. That's what these equity trust and all of these different trustee guys are, and a lot of those are scammers. Be careful, guys. There was a big one in Salt Lake here a year or two ago, probably 10 years ago. They called me in and they said, we want you to do all of the LLCs for our IRA people. And I smelled it, and I didn't like the smell of it. And a year before, the guy who was running it, and he was in the big fancy offices, driving to big cars and everything else, you know, 12-foot ceilings in the offices, marble. Oh, nice. The year before, the guy had been a sheetrocker, you know, hanging sheetrock. And I'm scratching my head, and I'm thinking, man, I'm in the wrong business, and blah, blah, blah. Well, 10 years later, and I said, no, I don't want to work with you. A little politer than that, but that's basically what I said. And 10 years later, which is a couple years ago, this guy shows up with about $50 million out of his clients' IRAs, and he's now living in South America. So, and the people did lose their money. So be very careful on these trustee guys. But you've got to have a U.S. trustee. It's U.S. law. It's protected. It's tax advantaged. What's this offshore stuff? I don't know. Follow-up questions. This is where I have to read, I guess. But we've gone a little long today, so maybe I won't do too many of them. Show answered questions. Come on, show my question sheet, guys. Ben is great. Here comes Soraya. Soraya is our technical person around here. She knows everything. LLCs in Indiana are only $98. Well, Utah's only $15. I just paid some of mine. Initially, then $23 every 2 years. Now we have to pay $15 every year. For compliance versus Nevada. I assume, Jay, you're just telling me that. I could yell out at Candy. She's got her door shut so she doesn't bother us. I think the Nevada fees are like $350, $450 a year now. If you're in California, you're insane. Well, that goes without saying. Any rate, so yeah, it's cheap in Indiana. It's cheap in a lot of states. California is $850 a year. I think Jersey's even higher than that. But you know, so you're good on you in Indiana. You got to have some compensation for freezing your butt off up there right now. I don't see any other questions. I think we ought to wrap it up and go home. I got to get home to Christy. Someone has to be with her now all the time. In fact, I've just told Soraya we're not doing this at this time next month. We're going to have to do it later because I do have somebody who comes and stays with her. So I pay him to come and stay with her between noon and 5. And yes, I'm usually there too. It's becoming to where we have to have 2 of us. She can still stand if you help her and transfer from a wheelchair. We've got the big electric wheelchair. Transfer from the big electric wheelchair to the bed or to the toilet. She can't get back up off the toilet, so we have to help her off the toilet. She has a feeding tube now in because they're extremely worried about her aspirating food down into her lungs, which is fatal often. You lose your ability to swallow. She can speak, but speaks in a very soft whisper now. Her voice is going. There's apparently a really good movie out. It's a documentary on ALS. It's called Gleason, like Jackie Gleason, only this guy's Steve Gleason. He was a football player. And this got the Sundance Film Festival Award for documentaries or such a year or so ago. And Amazon bought it. So you get it on Amazon, or I think you can get it on iTunes. It's called Gleason. And it gives you a good look at ALS. Christy and I actually haven't seen it. Our daughter says we don't have to. We're living the reality version. But we're living the reality version. The university says we've got 6 more months maximum, but they told us that 3 more months ago. So we're maybe, I'm going to say, coming in the home stretch, but the home stretch isn't good. When you say, how are we doing, I say fine. But that's like saying we love the food and we love the deck chair arrangement on the Titanic. And yeah, we hit that big iceberg thing a while back, but we're still having fun. So we're going to have a good Christmas. Our family will all be here. That may kill us off. We have 10 grandchildren, and our 4 from D.C. are coming in, and then the others are here already. So the entire family will be together this Christmas, and that'll be special. I hope you all have a wonderful Christmas. Be with your family. You don't know how long they're going to be here. But I appreciate you all as students, and wish you only the best. Thank you so much. We'll end webinar now, unless there's any big objections, but you can't talk to me, so I'm silent on the big objections. We'll pick you up on the other side of the year. How does that sound? Thank you.